Okay, so this time we're going to talk about closing entries under the periodic inventory system. So now these are the list of your temporary accounts under this inventory system. You have sales, sales returns and allowances, sales discounts, cost of goods sold, purchases, purchase returns and allowances, purchase discounts, freight in, expenses, freight out, income summary, and owner drawings. Now, you might be thinking, okay, wait, why does it seem like in this inventory system, we have more temporary accounts? Now, let me show you, especially in this part. If you remember, if periodic inventory system, then we have specific account names for the purchase, purchase returns and allowances, and purchase discounts. As compared to the perpetual inventory system, every additional purchase of inventory will just be recorded as debit merchandise inventory, and any decrease in inventory will be credit merchandise inventory. But for this one, for periodic inventory system, we do have the merchandise inventory beginning. This is a permanent account, or at least this is the ending balance of the previous period. And then purchases will refer to the additional purchase of merchandise. Purchase returns and allowances, oops, that should have been minus, okay. Purchase returns and allowances would pertain to any return that the business has given back to the suppliers. Let's say you bought a pencil and let's say a box of pencils. Say you have 12 pencils, but then you realize that there's only like one pencil that is quite defective, so you return it, and that will be recorded as purchase returns and allowances. And then we have purchase discount if you as a business would avail of the cash discount given by your supplier, so that will decrease the value of purchases. And then we have freight in, which increases the value of your merchandise. This is the cost that you needed to incur to transport the goods to your business. And considering all of that, we'll get total goods available for sale. Ending inventory under the periodic inventory system will be usually done through a physical count. And then we end with cost of goods sold. Now, what's the implication of this? Given that we have specific names for the transactions or the increases and decreases in the inventory under the periodic inventory system, it will look like this in the adjusted trial balance. So in this business, there's no record of merchandise inventory, which means there's no beginning inventory, 0. It means that perhaps this business just started this period, so we have 0 amount here. But then if you look at purchases, we have purchases during the period 480. Purchase discount is 1,800. There are no purchase returns and allowances. So eventually what we want to happen when we do the closing entries would be to transfer this amount to the merchandise inventory account, because what will happen is the values will end up here and they will survive more than one accounting period, meaning they will be carried over to the next period. And for purchases and purchase discount, they will be 0 after closing entries. Okay, speaking of closing entries, let's talk about the closing entries under the periodic inventory system. So if you notice, this time we have 5 steps. The first two steps are similar with the perpetual inventory system, and also the last 2 steps here. What just changed will be somewhere in the middle. We'll have to take into account the beginning merchandise and the ending merchandise. So what we're going to do is we will get the difference of the beginning and ending merchandise. And by doing so, we will debit income summary and credit the difference. That is, if merchandise beginning is greater than merchandise end. However, if the beginning merchandise is smaller than the ending merchandise inventory, then we'll have to debit income summary and credit merchandise inventory. Or another alternative would be to simply debit income summary, credit merchandise inventory beginning. That's one journal entry, and then add another debit merchandise inventory end and credit income summary. Now, if you're still a bit confused, don't worry. I'll show you in a bit how to close entries using our example here. Okay, so what we're going to do here is that we're going to start closing entries under the periodic inventory system. And first, we will pay attention to the temporary accounts with normal balances of credit. So we will not pay attention to these ones. We'll start at sales. We want to zero this out, so we debit sales, 500. And then we also need to debit purchase discount, 1. Okay, and in doing so, we credit income summary. That's going to be 501, 800. Next, we will close the temporary accounts that have a normal balance of debit. So we pair this with income summary. Then we have purchases, 480. Rent expense, 30,000. Then depreciation expense, 15. And utilities expense, 20,000. All in all, that will be 5,000. And then next step will be the third step. And first we need to consider our inventory. So in this scenario, our beginning merchandise inventory will be seen in the adjusted trial balance. We don't have any value here, which means that it was 0, meaning probably this company just started this year or this period. And then there's an additional info here. Ending inventory using physical count amounted to 178,200. So what we want to do is to move this ending inventory to this adjusted trial balance. So to do that, we need to debit merchandise inventory. That's going to be 178,200. Align everything here, and we're going to close that to income summary. Now for step 4, we need to determine if there's a net income or loss. So how do we do that? We already have sales, we have the expenses, but you don't know cost of goods sold. To compute for that, you need to consider total goods available for sale
minus ending inventory, that will give you cost of goods sold. So total goods available for sale will be purchases, that's 480, minus 1,800. We need to consider purchase returns and allowances and freight in, but since in this case, we don't have the accounts in the adjusted trial balance, we'll just make use of what we have. So this will give us a total of 478,200. Ending inventory is already given. This is 178,200. So 478,200 minus 178,200, this will be equal to 300,000. So our cost of goods sold is 300,000. So let's say sales is 500. Okay. Cost of goods sold is 300. This means our gross profit is 200. And then just to make this shorter, all the expenses, although you do really need to list them out, this is rent. I'm just gonna sum them up here. 30 plus 15 plus 20 will give me 65,000. So once I have my gross profit minus the 65,000, I can determine that I have a net income of 135,000. So since this is the net income, this is what we'll use for our closing entry. Net income, therefore we need to close income summary and credit owner capital. So 135. Okay, and then I'll take this out. Another way to actually compute for this, an easier way would be to look at the income summary balance before this step. So if you notice, you can actually draw a T account. So, but in this case, I'll just have to illustrate this way, like debit and credit. So for the debit of income summary, there's 545,000, and then for credit, we have from the first step 501,800, and also from the income summary we had of number 3, 178,200. So this would be 680. So what you will notice here is that the credit balance has a higher amount. So if we get the difference of these two, this will be give you a credit balance of 135,000. Now, since you want to zero out income summary for step 4, we debit income summary to zero that out and credit owner capital. And also, if just for the purpose of discussion, we don't have withdrawals here in our example, but if you do have withdrawals, it would look like this. We decrease owner capital by debiting it, and we will credit owner drawings X. That's how it will look like, but for this example, we'll just take this out. And this is your entire closing entries. What will happen is in your trial balance, you won't have any temporary accounts anymore. And this ending inventory will be moved to this merchandise inventory balance here. And also your owner capital will increase in value by 135,000. That's it. Thank you for listening.